You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by my co-host, John McEwen, and it's the 3rd of November 2022. And on this week's episode, we'll be discussing Airtel Africa, Unilever, Whitbread, Reckitt Benckiser, HSBC, and our US company of the week is Kraft Heinz. John, shall I start us off with a favourite of the show, Airtel Africa?
Yeah, it's the only company this week that got a double allocation in our fantasy portfolio.
There you go. I think Disney's the only other one in existence that got a double allocation.
Shows how much we like Airtel Africa.
Absolutely. So they have come out with their half-year results. For anyone we have covered them quite a few times on the show now, but for anyone who's not familiar with them, they provide telephone and mobile data services in 14 African countries, and they also provide payment services in, well, the majority of those countries. So they have come out with their half-year results, and the highlights included total customer base increased to 134.7 million, which was up 9.7%, with increased penetration across mobile data, where the customer base was up 10.6%, and mobile money services, which was up 24%. Average revenue per user grew 7.2% in constant currency, largely driven by increased usage across voice, data, and mobile money. Mobile money transaction value increased by 31.7% to an annualized value of 86.1 billion in Q2 2023. Reported revenue grew by 12.9% in the half to $2.565 billion, and all these figures will be in dollars because that's what they're reporting. Revenue was up 12.7% for the quarter. Constant currency growth accelerated to 18.5% in Q2, supporting half-year growth of 16.9%. Strong revenue growth in constant currency was reported across all 4 reporting segments. Mobile services revenue in Nigeria grew by 19.7%, in East Africa by 12.4%, in Francophone Africa by 12.1%, and across the group by 15.6%, with voice revenue up by 12% and data revenue up by 22.1%. Mobile money grew by 29.5%, driven by growth of 31.5% in East Africa and 23.6% in Francophone Africa. EBITDA increased by 14.3% to 1.255 billion in reported currency and 17.8% in constant currency, with EBITDA margins of 48.9%, an increase of 60 basis points in reported currency and 38 basis points in constant currency. Profit after tax was $330 million, which was 1.5% down due to higher foreign exchange rate and derivative losses of $160 million. Profit after tax excluding foreign exchange and derivative losses was up by 30.4%. Earnings per share before exceptional items was 6.8%, a reduction of 9.5%, largely as a result of higher foreign exchange rates and derivative losses of $160 million. Basic earnings per share increased to 7.9 cents, up by 3.7%, as a result of deferred tax asset recognition in Kenya. In 2022, the group prepaid $450 million of outstanding external debt at the holding company, and the remaining debt is now $550 million, which falls due in May 2024. The leverage ratio has fallen to 1.3x from 1.5x. CapEx increased by 26.9% to $310 million, in line with guidance, as they continue to invest for future growth. Additionally, Airtel acquired spectrum in key markets, including Democratic Republic of Congo and Kenya. So just to give the half-year gap figures, revenue up 12.9% to $2.565 billion, operating profit up 19.1% to $872 million, profit after tax down 1.5% to $330 million, and basic earnings per share up 3.7% to 7.9 cents. And net cash generated from operating activities was up 9.4% to basically $1 billion. For revenue by segment, voice revenue was up 12%, data revenue 22.1%, mobile money revenue 29.5%, and other revenue 11.9%. And it's becoming better diversified as well, actually. So of the 2.5 billion total revenue, 1.2 is now voice, 800 million is data, 300 million mobile money, and 200 million other. Return on capital employed now stands at 23.5%. And total customer base was up 9.7% to 134.7 million. Data customer base was up 10.6% to 48.6 million. And mobile money customer base was up 24% to 29.7 million. In terms of the share price, it's taken a bit of a whack recently. So it's in the last 3 months, it's down 20%, and it's down 20% for the last 6 months as well. And then for the last year, it's up 7%. It's now trading on a PE basis at the cheapest since we started covering it on the show. So it now trades at a PE of 8 with a market cap of 4.4 billion and a dividend yield of 3.37%. I think the baby's being thrown out with the bathwater a bit here in that it was down quite a big amount on the day of the earnings. I can't remember the exact amount, but it was down like 10% on the day. And I remember I was actually at work when I read the earnings, and there's another guy in the office who owns Airtel Africa. And I'd read the earnings, but not looked at the share price. And I didn't realize until he told me that the share price was down. I assumed it would be up based on that because I thought that was a solid half and a good quarter. So I'm not particularly concerned with the share price. I continue to like the business. It's continuing to deliver. It's now the cheapest we've ever seen it. So I'm very happy holding it. And I wouldn't be against adding to it, actually. I think it's very reasonable at this valuation. John, what are your thoughts on these results and the valuation?
Yeah, I mean, I certainly think the valuation, it's very, very cheap. And I would agree. I read the results and then looked at the share price, and I was very surprised because I was expecting, like you, I was expecting the market to have reacted well to it, but it hasn't. And it looks cheap enough for me to buy more shares, really. I think I started my position, it was maybe about 80 pence a share. It's now about £1.16, but trading at under 8 times earnings, and it's still continuing to deliver. I like it a lot for all the reasons that you've said.
And it's got a nice dividend as well now.
Yeah, well, I mean, it has always had the dividend.
It has, yeah.
And I've reinvested what it's paid out so far. It continues to reward you.
Yeah. Should we move on to a business that hasn't continued to reward you?
Well, I don't know about that. Unilever, which is we've covered it a lot of times on the show before, but the largest of the UK's consumer goods companies and owner of brands from Dove soap to Ben & Jerry's ice cream. They had the trading statement for Q3 out this week with the third quarter sales of 15.8 billion euros and underlying sales growth of 10.6%. Growth came from across the divisions and was fueled by price rises of 12.5%, which more than offset the 1.6% drop in volumes. The largest volume declines were seen in personal and home care divisions, with 4.1% and 2.6% declines respectively. Both these divisions saw the largest price rises. Overall turnover increased 17.8%, including a currency impact of 8.8% and minus 2.1% from disposals of net acquisitions. The billion-plus euro brands, accounting for more than 50% of the group's turnover, grew 14%, led by strong performances from Omo, Hellmann's, Rexona, Magnum and Lux. Beauty and Wellbeing saw underlying sales growth of 6.7%, with turnover up 24.4% to 3.3 billion euros. Personal Care delivered underlying sales growth of 8.9% to 3.6 billion euros, with turnover up 20%. Home Care had underlying sales growth of 13.6% to 3.2 billion euros, with turnover increasing 22%. Nutrition saw underlying sales growth of 11.8% to 3.3 billion euros, with turnover up 4.8%. And ice cream saw underlying sales growth of 13.2%, 2.4 billion euros, with turnover up 20.8%. We break those results down geographically. Asia Pacific, which accounted for 45% of Q3 turnover, saw underlying sales growth of 12.5%, with 12.1% from price and 0.3% from volume, driven by strong performances from home care and ice cream. India showed strong growth with double-digit pricing and positive volumes, supported by innovations and continued strength in the premium portfolio. China grew in the low single digits as the market growth reflected some of the lockdown effects and remained more muted than previous years. Indonesia delivered price-driven growth, while volumes were affected by a reduction in stock in trade levels. Vietnam, the Philippines, and Thailand delivered double-digit growth, which was boosted by lapping the lockdowns in the prior year. Turkey posted another quarter of double-digit growth across all business groups, driven by both price and volume. In the Americas, which accounted for 35% of Q3 turnover, underlying sales growth in North America came in at 8.3%, with 11% from price and negative 2.4% volume, helped by strong double-digit growth in nutrition, notably dressings and ice cream. Latin America delivered underlying sales growth of 17.6%, with 23.2% from price, negative 4.6% in volume. All business groups delivered strong double-digit underlying price growth, which stepped up versus previous quarters. The volume decline was similar to the first half, supported by consumer-relevant innovations in a portfolio that spans across the different price points and channels. And Europe, which accounts for 20% of Q3 turnover, underlying sales grew 5.4%, with 8.9% from price and negative 3.2% volume. Growth sequentially improved in the third quarter, helped by a strong ice cream and nutrition performances. The group also commented that the portfolio reshaping is continuing and the sale of the global tea business completed. In terms of valuation, Unilever has a market cap of £101 billion and trades at just under 17 times forward earnings, compared with a 10-year average of over 19. It has a prospective dividend yield of 4%. I thought these results were good, managing to increase sales despite the tough macroeconomic conditions as a result of the price rises and the strong brands that they have. It's not as impressive as Nestlé, which we covered recently, where they managed to increase both price and volumes. It's reflected in the price, though, and I think there's probably a case for optimism, particularly with the new chief executive expected in the near future, which will hopefully realise further value in the business. I do have Unilever shares, and I'm very happy holding them. Sam, what were your thoughts on these Q3 numbers?
I thought they were very good. I thought the 10% revenue increase was certainly higher than I would have expected them to do. I'd have expected them to put maybe 7 or 8%, and I would have considered that a good quarter. The only criticism I have is I just think that 1.6% drop in volumes, Nestlé have shown it doesn't need to be like that. You can do even better. If I hadn't seen Nestlé a few weeks ago, I'd be saying fantastic. Wouldn't be able to fault them. But having seen Nestlé's, I think there probably is still a bit of room for improvement. That being said, it's significantly cheaper than Nestlé's, under 17 times earnings or forward earnings compared to 21 for Nestlé. So you are paying up for Nestlé. Probably the last couple of quarters, I think they've been a bit more positive. Whereas I think probably, the last year, 18 months before that, I just always felt quite underwhelmed with the results. Whereas now they are actually starting to put out good results, it feels like to me.
I suppose that is impressive in the current environment.
Yeah, and it just shows the power of the brands they've got, because people are still paying for them.
Yeah, no, absolutely. On to Whitbread.
Yes, so Whitbread is another business we've covered multiple times on the show. We've usually been very critical of it. So they've come out with their half-year results, and in the first half, their revenues more than doubled to 1.4 billion, and they're now up 25% on pre-pandemic levels. This was driven by a strong rebound at Premier Inn as meetings and events returned to the UK and the German operation. On the downside, trading conditions in the value end of the pub restaurant market remained challenging. Underlying pre-tax profit was up to 272 million against a loss of 57 million last year and up 15% on a 3-year view. Free cash flow was up 24% to 232 million and net cash levels improved from 141 to 182 million. They've also announced that the interim dividend is returning and they'll pay out 24.4p a share, which 1% of the share price. They remain confident of the full year outlook, but the effect of inflation and accelerated investment has seen it guide for costs to increase by 60 million. Interestingly, they've currently got a capacity in the UK and Ireland of 82,700, and they feel the potential ceiling is 125,000 rooms, which I was somewhat surprised by, because that's a significant increase. And I never felt like the UK, I feel like the UK is pretty saturated for budget hotels, but clearly not. And they're aiming to be the number one budget operator in Germany. Currently, about 60% of the rooms in Germany are run by private hotels. So they think there's an opportunity for a more experienced, bigger chain to step in and get some decent market share. I think that's more likely, actually. They seem to be doing quite a good job in Germany, and it doesn't seem like they've got that same level of saturation, certainly at the bigger end with the bigger players. I think they'll be more likely to get a foothold in Germany than 125,000 rooms in the UK, but we will see. And in terms of the valuation, they don't have a year of earnings yet to give us. So they trade at a forward price to book of 1.21, and that compares to a 5-year average of 1.64. And the prospective dividend yield is 2%. I'll just double check that they don't have earnings. I'm pretty sure we still don't have any earnings yet. Yeah, still no PE ratio. But it does actually look like they're starting to move in the right direction. This is still not a business I'd particularly want. If I wanted exposure to the industry, I would get IHG, which I think I just prefer the asset light and capital light business model. That being said, I think these are the most positive results we've seen from Whitbread since we started covering them on the show. I can now start to see an argument forming as to why someone might consider buying the shares. I think the German expansion seems to be going quite well. And okay, I'm a bit skeptical personally of whether or not they'll be able to do it, but they are making noises about expansion in the UK as well, and quite significant expansion. In terms of the share price, it's £25.60 a share, and that compares to a 52-week high of £34 and a 52-week low of £22. And the shares are down 20% in the last year, up 18% in the last 2 years, down 26% in the last 3 years, and down 20% in the last 5 years. So probably not for me, but probably for the first time since we've covered it, I'm starting to see an argument for why someone else might like it. John, what are your thoughts on these results and the valuation?
Yeah, I think, as you've sort of alluded to, there's more of an investment case that is now building for Whitbread, which when they used to have Costa, that was the growth part of the business. And then after that had been sold to Coca-Cola, you had the pandemic. There wasn't a lot to like, but I could probably buy into, or at least in part into that investment case in Germany and the growth that they would get from that. And I think it probably does also have a brand in its own right. I would always stay at a Premier Inn over a Travelodge. And I don't know whether I'd seriously put it on my watch list, but it's, I think, going in the right direction. So it'll be an interesting one to follow on the show.
Yeah, I mean, in fairness, I think just because of the industry and the type of business it is, there's not really anything they could do to get on my watch list.
Yeah, it's not, well, certainly after Costa disappeared, it's quite far from that for me.
Yeah. Shall we move on to a business that is very much on your watch list? Well, do you own this one?
I do.
Right, okay.
I own all three today of the ones I'm covering. So yeah, Reckitt Benckiser, the UK's second largest consumer goods company, with brands including Finish, Dettol, Lysol and Durex, had their Q3 results out, with group net revenue up 7.4% on a like-for-like basis, coming in at £3.7 billion, with net revenue getting a currency boost of 8.5% from a weaker sterling. And higher prices and the mix of products sold offset about 4.6% decline in the volumes. If Lysol sales are excluded from this, volumes only fell around 1%. 70% of the portfolio less sensitive to COVID dynamics grew in high single digits. Year to date grew in the low double digits. Excluding the positive impact from the US infant formula and child nutrition business, growth was in the mid single digits, and year-to-date in the high single digits, driven by continued innovation, improved in-market execution and pricing across the portfolio. Hygiene like-for-like sales declined 1.2%. Performance improves as Lysol base continues to normalise. Hygiene grew 3.3%, excluding Lysol, led by Finish, Harpic and Vanish. Health like-for-like growth came in at 10.7%, with continued strong momentum led by over-the-counter brands of Mucinex, Nurofen and Strepsils, and intimate wellness portfolio of Durex and KY. Nutrition like-for-like growth came in at 24.7%, driven by mid-single-digit growth in developing markets and over 40% growth in the US, with strong execution in the temporary infant formula shortages. Growth includes an estimated 20.3% benefit from temporary competitor supply issues. In terms of geographies, North America saw volumes fall 5.4%, but with positive price mix of 12.5% and FX impacts, revenue was up 23.2% at £1.3 billion. Europe saw volumes fall 1%, but with a positive price mix of 11.1%, revenue came in at up 10.8% at £1.1 billion. In the developing markets, volumes fell 7.2%, but with a positive 12.2% price mix, revenue grew 8.4% to €1.2 billion. Year-to-date, group net revenue has grown 7.6% to £10.6 billion, volumes declining 0.8% and a positive price mix of 9%. In terms of outlook, following a strong year-to-date performance, the group reiterates their full-year like-for-like net revenue targets, but narrow the range to positive 6% and plus 8%. In terms of valuation, Reckitt has a market cap of £41 billion and trades at 16.5 times forward earnings, compared with a 10-year average of around 20. Shares yield 3%. I thought these results were probably broadly as we would have expected. They did have a disproportionate tailwind from COVID, which we're seeing with the Lysol and Dettol sales during the pandemic when compared with peers like Unilever. It's very disappointing that Lexman Narishman is leaving. He came in from PepsiCo to turn the business around and recently left for Starbucks. But again, they've got very strong brands, which they're managing to grow revenue with only small drops in volume, particularly if we look at the whole year. And it's another company that I hold, albeit in smaller quantity to Unilever, but I'm comfortable continuing to hold it. And again, I think we're seeing the power of those brands in a challenging environment. It's not outrageously expensive either. It's cheaper than Unilever and it's much cheaper than Nestle. Sam, what did you think of these Q3 or this Q3 statement from Reckitt?
Not as good as Unilever.
Which is also not as good as Nestle.
Yeah, but I think I will let them off for the 4.6% decline in volumes, because I think the comments about normalization of like some of the brands is fair, because they have quite a few brands that were big COVID beneficiaries because they had all the cleaning products. So if you exclude the normalization, the volumes only fell 1%, which was pretty similar to Unilever, but they weren't able to rise their prices to the same amount as Unilever. They only got them up 7.4%. So even if you give them the benefit of the doubt on the volume, still not as good as Unilever. All right, it's cheaper than Unilever, but it's only a bit cheaper. The dividend's not as good. And I don't think the brands are quite as good. So I don't know. When it's at a forward P of 16.5 compared to 16.7 for Unilever, with a dividend of 3 compared to 3.9, I don't know why you would pick Reckitt over Unilever with the results Unilever's putting over Reckitt.
Okay, on to our next company, a bank. We haven't covered a bank for a while, actually, have we?
No, I don't like them. That's partly why I never picked them. But then occasionally we get listeners tweeting, asking us to cover them. So it's sort of one of them things where every now and then I think, well, I've got to pick one, even though I don't like it. But
okay, you pick the biggest.
Oh yeah, I wanted a bit of a change. I've not actually. I think we have covered this one before, but I don't really remember much about it. So anyway, HSBC have come out with their Q3 results, and underlying revenue rose 27.7% to $40 billion, and all these figures will be in dollars in the first 9 months of the year, reflecting an increase in net interest margin, which is the difference between how much a bank earns in interest on loans compared to what it pays on deposits. There was a 3.3 billion rise in net interest income driven by higher interest rates. So for anyone who's not aware, when interest rates go up, banks do a lot better. On a quarterly basis, the group's total underlying loans and advances to customers fell 18 billion. The fall was partially offset by higher mortgage balances in the UK and Hong Kong. Quarterly underlying pre-tax profit was 8% better than analysts expected, coming in at 6.5 billion. However, the bank also recognised 1.1 billion of expected credit losses, provisions put aside because of higher economic uncertainty and continued weakening of mainland China's commercial real estate sector. HSBC's CET1 ratio, which is a key measure of the capitalisation, was 13.4%, which is lower than the minimum 14% targeted. This is one of the reasons I don't like doing banks, because they've got all these extra ratios and stuff you need to know about. For 2023, HSBC now expects net interest income of 36 billion, which is higher than planned, and that's because of the increase in interest rates. That was mainly it from the trading statement, but one other thing that's worth mentioning is that they're mainly Asian anyway, so they're about 80% of the pre-tax profit already comes from Asia, but they're looking to refocus to become even more Asia focused. So they're selling the French retail operation and the US mass market business, and the capital that's going to come from that is going to go straight into the stronger performing regions in Asia. So it's mainly Asia now, but I think in 2, 3, 4, 5 years time, I think the plan is for it basically to be all Asia. In terms of valuation, the business trades at a PE ratio of 8.39, forward price to book of 0.58, and that compares to a 10-year average price to book of 0.88, and the prospective yield over the next 12 months is 7.6%, which is very juicy, I do have to say. My thoughts, I thought these were good results. You would expect them to be good results because it's a bank and interest rates are going up. I do like that it's an Asian focus. Yeah, I mean, it's probably, if you wanted to add more Asia exposure to your portfolio, I think it is something I would possibly look at, because it's probably a safer way to do it. I like it. I think it's quite an interesting stock. I think of the banks listed on the FTSE, it's possibly the most interesting because of that Asian focus. And these are very, very good results, and the dividend is very attractive. John, what are your thoughts on the results and the valuation?
Yeah, I mean, I would echo what you said about it being, or the banking sector being more difficult to understand, or certainly having to have more of a, I suppose, a specialist knowledge about them. But it would appear cheaper. And like you say, from the emerging markets exposure, it's the bank that you'll be drawn to of the listed ones in the UK. Similarly to Prudential, if you were looking at the insurance companies, and Prudential's essentially, it shed those, well, the domestic sort of businesses like M&G and then the Jackson business over in the States, and it's now really just focused on Asia. I suppose the real story is the net interest margin and all of the banks being lifted by that tide. I guess if it goes further and if the macroeconomic situation deteriorates more, the banks are going to suffer. But at the moment, they're almost in that sweet spot. So making lots of money and not expensive, with very generous dividends, which are well covered. Probably not one for me though, but yeah, very good income.
Yeah. Should we move on to a business and that is simpler to understand than a bank?
Yes. So yeah, baked beans. It's Kraft Heinz. So the third consumer goods stock of the week, and actually the smallest of all three. It's our US company of the week, and it has brands from, well, Heinz baked beans, Heinz ketchup, Jell-O, Philadelphia, and the company had their Q3 results out last week. Net sales increased 2.9% versus the year ago period to $6.5 billion, including negative 6.4% point impact from divestitures and acquisitions, and a negative 2.3% percentage point impact from currency. Organic net sales increased 11.6% versus the prior year period. Price increased 15.4 percentage points versus the prior year period. Growth in both reportable segments that was primarily driven by price increases to mitigate rising input costs. Volume mix declined 3.8 percentage points versus the prior year period, with declines in both reportable segments that were primarily driven by supply constraints and elasticity impacts from pricing actions. Net income / loss decreased 40.8% versus the year ago period to $435 million, primarily driven by higher non-cash impairment losses, unfavourable changes in other expense / income, and lower adjusted EBITDA versus the prior year period. These factors were partially offset by lower interest expense, primarily due to debt extinguishment costs in the prior year period. Adjusted EBITDA decreased 5.5 percentage points versus the year ago period to $1.4 billion, with performance including an unfavourable impact from divestitures and acquisitions of 6.1 percentage points and an unfavourable 1.4 percentage point impact from currency. The remaining year-over-year increase in adjusted EBITDA is a result of the higher pricing and efficiency gains that more than offset higher supply chain costs, reflecting inflationary pressure on procurement, logistics, and manufacturing costs, and higher commodity costs, mainly in dairy, packaging materials, soybean and vegetable oils, with energy, as well as unfavourable volume mix. Results continue to reflect the difference in timing between inflationary pressures and the mitigating actions that were taken. Diluted earnings per share was down 35 cents, down 40.7% versus the prior year period. Year to date, net cash provided by operating activities was $1.5 billion, down 38% versus a year ago period, primarily driven by higher cash outflows for inventories. In terms of outlook, the company continues to expect strong financial performance for 2022 and reaffirms 2022 organic net sales growth of a high single-digit percentage increase versus the prior year period. In terms of valuation, Kraft Heinz has a market cap of $46.6 billion and trades at just 14 times earnings, yields over 4%. I thought these results were disappointing, particularly as Kraft Heinz has so many of the household names, particularly in the US. But it's the numbers, as we've now seen with Nestle, Unilever and Reckitt, probably in that order, it's not matching up to them. And I think that is something that's surprising. We didn't talk too much about the debt. That is it's certainly coming under better control than it was. I guess it's probably reflected in the valuation of just 14 times earnings. However, I think as a company, it should be doing better. It's still probably, or I would consider it a turnaround story since the impairment charges of 2018, well, I think it was actually 2019, but there's still a long, long way to go before it's, I think, firing on all cylinders, as we've seen with Nestle. I am a shareholder. I'm probably comfortable still holding it. It's paying a decent dividend, so I'm just reinvesting that cash. And I've certainly been benefited a lot because when I took a position in it in 2019, we've had, well, the pound has weakened a lot against the dollar. And as someone who's buying in the pound, that's benefited me a lot. But I think the numbers, and it's doing better than it was, but it was a very low base. So yeah, I'd like to see it really striving and trying to get up there with Unilever and Nestle. But like I say, we've still got a long way to go, I think. Sam, is Kraft Heinz something you would look at?
Yeah, the results. It's just very similar comments to what I said for Reckitt and for Unilever, just not as good as Nestle. What's the valuation?
It's 14 times earnings.
So that's the cheapest?
It is the cheapest. So it's, I suppose you'd say it's reflected in the price. These numbers, you compare it with over 20 times for Nestle. Unilever's up there at sort of, what did we say, 16 and a half?
I mean, for the American one to be the lowest, that's unusual. I think it's got some very strong brands, very, very strong brands. I think I like the brands more than I like Reckitt's. I quite like it at 14 times earnings, actually. And that dividend yield's over 4%. So it's got the best dividend out of the lot as well. Your volumes drops. It's obviously it's no Nestle there, but it's raising prices, and I think it'll be able to continue to do so with a lot of those brands. I actually quite like it at that price. I can't remember what the PE was last time it was on, but I don't think it was actually, maybe it was about 15.5, but no, I quite like it at that price actually, especially with those brands. I mean, Heinz is just fantastic.
Would you take a look at it with the weakness of sterling? Would that put you off a bit?
Yeah, that's a good point. But that's not the stock's fault, is it?
It's not the stock's fault, but looking at it from a UK investor.
Yeah, I think I'd be a lot happier if I'd already bought it. I guess the problem is though, it's dropped to 14 and you can't top it up.
Yeah.
I see what you mean, but I don't know. I think if you like the business, you buy the business. We don't know what the exchange rate's going to do. We've had this conversation before, but we could look back in 5 or 10 years' time and think, well, we should have just loaded up on American stocks now, because although it was bad, it was about to get a lot worse.
Yeah, no, absolutely.
So I think you want to keep an eye on it, but I don't think you should be trying to be too cute with exchange rates. I think you've just got to take the price you're given a lot of the time.
Yeah. I'm certainly enjoying my dividend from
Heinz
now. It's quite a lot more than I was getting before. So,
of the 6 businesses, of which you own 4 today, if you had to pick one, which one would it be?
I would go Airtel Africa every day. It's I think it's the cheapest, but it's also got the best growth prospects ahead of it. And particularly that mobile money side of the business is very exciting.
It's going to be a little boring, but I think anyone who's listened to us talk about Airtel Africa before isn't going to be overly surprised, but I'm also going to go with Airtel Africa. But I think as a second, I'd probably have a bit more of a decision. For me, it'd be Unilever or Kraft Heinz. But I wouldn't have expected Kraft Heinz to be more attractive than Unilever, but it possibly is actually. I do like it at 14 times earnings.
And I suppose it is that portfolio that it has.
Yeah, just absolutely world. I mean, Unilever's got some world-class brands too. I'd say they're actually probably about on par. Yeah. Whereas there's just something about the Reckitt brands that for me, they're just not quite as good, I don't think.
Yeah.
But Reckitt has some very good brands as well, that being said. I don't think it's got as many good brands as Unilever and Kraft Heinz. No,
I would tend to agree with you. But some people own all the brands, Sam.
Well, you do.
Yes. Okay. Well, thank you again for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.